The Fed is gearing up to pivot and cut interest rates sooner than you think, and that's going to have a massive impact on asset prices, the economy, and inflation. When we look into history, when we look in the last 50 years of recessions in America, we see that after the Fed pivots and cuts interest rates, asset prices crash by even more. For instance, on this table, we're looking at the last 8 recessions in U.S. history going back to 1957, and we're looking at the month that the Fed pivoted and cut interest rates to quote-unquote save the economy. And what you can see on average in these recessions is the S&P 500 crashes a lot after the pivot, and it tends to bottom out anywhere from 12 to 18 months after that pivot. And what I find super interesting here is that in every economic cycle, the Fed does pivot. It's not a question of if they're going to pivot and cut rates. It's a question of when they're going to pivot and cut rates. And right now, Jerome Powell and the Federal Reserve is very hawkish. They're making statements like they're going to increase interest rates as long as they need to tame this inflation that we're experiencing right now of 40-year high inflation. And so long as the inflation rate at around 8% year over year is substantially above the unemployment rate, which is 3.5%, the Fed is going to continue increasing interest rates in the short term. However, I am predicting a pivot in Fed policy towards cutting rates once this inflation rate comes down to around 4 or 5% year over year, and when the unemployment rate goes up to 5%. So basically when these lines cross is when I believe the Fed is going to pivot, and I think that's going to happen sometime in early 2023, maybe January, maybe February. The economy is going to take a visible nosedive. All of a sudden, that's very hard for the Fed to ignore and brush off, and thus they're going to have to come off their rate hiking and go into their rate cutting, which is going to be a signal that the recession, and particularly the job losses in the labor market, are going to get even worse. This was the other kind of crazy thing I found when I did this research into the last 8 recessions, is that when the Fed pivots, it's a signal that the labor market for the next 2 years, the next 3 years, is really going to struggle. And let me show you what I'm talking about. On this table, we're looking at, again, the last 8 recessions, the date of the Fed pivot. But instead of looking at the bottom of the S&P 500, we're now looking at the date that the unemployment rate peaked in America in each recession. What do you see here, everyone, is that the unemployment rate peak occurs anywhere from 18 to 36 months after the Fed pivots. So that's shocking, everyone, right? When the Fed and Powell eventually pivot, say in early 2023 to cut rates, that's not going to save the economy. That's going to be a signal that the economy, the Main Street economy, is going to get a lot worse over the next 1, 2, maybe even 3 years, which is why asset prices are going to go down. Because if people lose their jobs, they don't have as much money to spend, consumer spending goes down, businesses have to lay even more people off, and businesses have to shut down, their earnings go down, and thus their stock prices go down. But as I mentioned in the beginning, there's also a housing market impact here. And housing is obviously very interest rate sensitive. So there's this idea percolating right now, I see in the housing industry, that even though the housing crash has started, a lot of people I talk to are thinking that when the Fed eventually cuts rates, that's going to be good for the housing market and the housing market's going to rebound. But folks, that is not at all what happened back in 2007, 2008. We can see the Fed pivoted in August 2007, and after that pivot, home prices went down for another 5 years. Home prices went down from 2007 to 2012, and they bottomed out in America at about 25% below the level they were at when the Fed pivoted back in 07. And in certain markets, that was 50% below, like in Miami. In Phoenix, it was 55% below. In Los Angeles, it was 35% below. And so this is another trap that I want to help you all avoid falling into. So there's going to be a lot of people 6 months from now who say, now's the time to buy a house once the Fed signals that they're going to cut interest rates, and that is not going to be true. And really the reason here, everyone, that the Fed pivot is a signal that the economy is going to get worse and unemployment rate is going to go up and that stock prices and home prices are going to go down, is because what the Fed pivoting really does, it's acknowledging how bad the recession is getting. And the thing that you should all kind of understand as a home buyer or a real estate investor or someone who just wants to take better care of your finances is that when the recession train leaves the station, and when it gets far enough away from the station, the Fed at a certain point is powerless to stop that recession. Once the consumer sentiment gets so low as it is today, consumer sentiment is near a record low over the last 70 years. Once small business sentiment gets so low, small business expectations for future growth are near an all-time low. This idea of a recession gets entrenched, And then all of a sudden, people and businesses just cut back in unison. They cut back their spending, they save their money, and that inevitably leads to a downturn, because all you need in the US economy for a big recession is 5% of people to lose their jobs and everyone else to spend 5% less. If that happens, 5% of people losing their jobs and then everyone else spending 5% less, that will create a 2008 style crash. That's all you need. So we're very much operating on the margins in this economy. It's small changes up or down have a big impact on where things are going. This is what the mainstream narrative on the Fed pivot completely misses. Like, there's these people who think the Fed has utter and total control over the economy. That is not true. Another great example of this is the dot-com bust. In December 2000, Alan Greenspan pivoted and cut interest rates, and he cut interest rates by a lot, going from 6.4% all the way down to 2%. But that did not stop the crash into the stock market. The S&P 500 proceeded to go from 1430 all the way down to 815 over the next 2 years. That was a 40% decline after the Fed pivot. Another great example of this is back in the early 70s. In the 1973 inflation recession, has some similarities to what we're seeing today. Fed pivoted and cut interest rates in October 1973. Stock prices then proceeded to go down by another 45% after that pivot. The other amazing thing about these Fed pivots in history is regarding inflation. You know, it's amazing how common the current situation is in America, where inflation is higher than we want and the Fed is rushing kind of behind the curve to tame that inflation. That happens in pretty much every recession, maybe not to today's inflation level, but some version of this is evident in almost every economic cycle where the Fed is chasing inflation, aggressively hiking interest rates to combat inflation, and then they end up helping cause a bigger economic downturn. And that is something that I think is inevitable at this point. So I think at this point it's becoming pretty obvious that the Fed is kind of going a little too far in the other direction. They're really getting aggressive with these rate hikes, going from 0% Fed funds rate to probably 4% by the end of the year. That is a crazy fast surge. And these higher interest rates are going to have huge economic consequences, not so much like right now, but over the next year into 2023, there's a lag effect to interest rate increases in terms of the drag it has on the economy, because it takes time for people and businesses to accrue debt at the higher interest rate levels. Like, not every business needs to refinance their debt over the last 3 to 6 months, but over the next 12 to 18 months, a lot more businesses are going to need to refinance at a higher interest rate, which is going to mean less money after they pay their bank and their debt service. The same goes for home buyers. Even though home sales and mortgage issuance has gone way down this year, we're still going to have at the end of 2022 about 4 million newly issued mortgages at these higher interest rate amounts, which are going to mean people have less money to spend into the economy after paying their mortgage debt service. The same goes for, people buying a car. I talked to a friend in Dallas. He just bought a used Honda a couple months ago, and his monthly car payment is something like $800 a month, given how much car prices and the interest rate on car loans has gone up. And so that's obviously going to impact his spending. And as more and more people take out this debt at higher interest rates, it's going to cause a drag on consumer spending overall. It's actually going to lead to a lot of defaults down the road, but that doesn't all happen immediately. It takes time for these interest rate hikes to filter through the economy. And the longer the time passes and the more and more people accrue this debt at higher interest rates, the worse the economy is going to perform into the future. And, this is the Fed's intention, right? This is what the Fed wants to combat inflation. But I think the question to ask is inflation really going to continue over the next 6 to 12 months? And there's varying opinions on this, but my opinion is we're seeing deflationary pressure in the US economy right now, particularly through the housing market. Home prices are going down, but maybe even more importantly, rents are starting to go down. And the cost of rent, that's roughly 1/3 of the inflation calculation. And so if rents continue to go down, that is going to bring down inflation. And that is starting to occur as the Fed is aggressively hiking interest rates. And ultimately, my prediction is that this is going to end in a deflationary crash. I've talked on this channel before about what happened in 1920 and 1921 during the Depression of 1920 and 1921. I think something very similar is going to play out over the next couple of years, where the Fed is over tightening, they're increasing interest interest rates too fast. They're taking money out of the system through quantitative tightening, and that's going to lead to a sharp deflationary shock, which actually, might be good for our economy. If we have a reset where prices of everything get lower, rent gets cheaper, that could lead to actually really good economic growth in the future, but it's probably going to require some pain in the short term. Lastly, folks, I just want to finish this off by giving you all a message kind of about my framework and thinking for this downturn in this housing crash and my prediction for where things are going. And it's all based off analysis of fundamental data. If you go back 5 months ago to April and May, I was one of the few people predicting that the Fed would continue hiking interest rates through the stock market crash that occurred this summer. And the way I knew that the Fed would continue hiking interest rates this past summer was by looking at the comparison of inflation to unemployment rate. It was very obvious based off the Fed's dual mandate that they would continue hiking so long as this inflation and unemployment rate difference existed. However, now I am predicting that the Fed will stop hiking and start cutting based off the same methodology, because it's clear to me that inflation is going to be going down pretty soon while the unemployment rate is going to be going up. So this just to me underscores the importance of looking at fundamental data to help you drive your decision making with your money, with your investments. Because if you just rely on what mainstream articles are saying, you're going to get jerked around in all directions. So try to establish, and what I'm going to help you all establish on this channel is a fundamental viewpoint of the economy on where things are going based off data. So if you want more of that and you're not a subscriber to this channel yet, make sure to hit the subscribe button and turn on those subscribe notifications so you receive updates every time I post a video. And also make sure to leave a comment below. Let me know your thoughts on this video, particularly when do you think the Fed is going to pivot? Do you think Powell is super committed to hiking interest rates for the next 12 months? Or do you think he's going to bend at a certain point and cut rates like every central banker over the last 50 years has?